One of the companies that Warren Buffett is buying actively these days is SiriusXM. It may be harder to see in Berkshire's 13F filing because the ownership is spread out among these three stocks, SIRI, LXXMK, and LSXMA, but they basically represent the ownership of the same single company. So today, I will discuss some pros and cons of this business to figure out why Buffett likes this stock and how it may or may not suit us. SiriusXM provides satellite radio subscription services to various cars in the United States and Canada. These services are also available through apps at varying prices. This company was formed from the merger of Sirius and XM in 2008, and Liberty Media got involved when the company almost went bankrupt around that time. Now, let's look at the three bear theses on this company. The first and biggest challenge that SIRI faces is increased competition from other media outlets like streaming services Spotify and YouTube. As you can see here, SiriusXM has 8% market share of the total time spent on listening media, but YouTube and other streaming services already surpass SIRI. Looking at the historical number of subscribers, this company was surprisingly growing fast up to 2019, but the number of subscribers is definitely stagnant in recent years and even falling slowly. In this 10-year graph, we added the quarterly net subscriber change in orange line, and as you can see, SIRI's subscriber count fell quite a bit in this first quarter 2024. This falling interest in SIRI can also be shown in this Google search trend, and as a result, in 2023, SIRI's full-year revenue fell by 1%, and the operating income fell by more than 3%. These financial impacts might seem small, but given the strong competition for more trendy and powerful competitors, including Spotify and Google, market is definitely putting discount in SIRI's future outlook. The second bearish view relates to the cash flow. Despite falling revenue and profit, SIRI must continue to invest in its satellite infrastructure and content library in order to keep up its current level of service. For example, as we can see here, its capex is actually accelerating recently and surpassed the D&A in 2023. This is because the company is in a capex cycle where it needs to launch 4 satellites now in order to replace old satellites, which can be used for up to 15 years. So basically, SIRI is currently investing for the next 15 years, while its underlying business is stagnant or even falling slightly with gloomy outlook. As a result of this combination, SIRI's free cash flow fell by more than 22% in 2023 alone. And in the first quarter earnings call recently, the management expected this 1.2 billion level to remain throughout 2024. Third, bears worry that SIRI has continued to increase its debt level in the past decade, and the combination of rising interest expenses, falling revenue, and increasing capex all indicate that things could turn very negative fast. Now let's turn to some bullish views on SIRI. First of all, bulls point to the great underlying economics SIRI has, and this is shown in its ROIC number, which has increased over the past decade and is settling at over 50% in the past 7 years. For your reference, Warren Buffett's rough benchmark for good business has about 20 to 25% of ROIC, and obviously, SIRI is well above that threshold, and this number would have influenced Berkshire's view. However, despite such historical success, the future of SIRI is still worrisome, as we saw before in this decreasing subscriber count. Regarding this, bulls admit that the company is not growing as it used to, but if you look at the detail, the subscription base can be stabilized. For instance, net churn rate, which is an important number to assess a subscription business, is very low at 1.6%. So even though SIRI is not attracting many new customers, the existing customer satisfaction is quite high. Also, SIRI is currently upgrading its hardware network to the next generation, which can increase SIRI's attractiveness to users and also for advertisers. And in the most recent earnings call, the management confirmed that these assumptions are slowly showing up in the operating statistics and with the 8% increase in the ad revenue in the first quarter. Next, bulls claim that SIRI's debt problem is exaggerated, and we ought to think about why SIRI borrowed all that money in the first place. As we saw through this ROIC graph, SIRI has great financial performance, which means the business earns very high rate of return above its cost of capital, and never really needed to borrow money to maintain this. However, Liberty Media, the controlling shareholder of SIRI, is well known for its use of leverage to maximize shareholder return. And Liberty probably couldn't just pass on the ultra-low interest rate environment that we had for the past decade before Fed's rate hikes in 2022. For example, we can see here that Siri's cost of borrowing is in fact very low and fell as low as 4.4% recently. And regarding this, we may ask, if Siri didn't need the borrowed money for operations, what did the company do with the extra cash? Well, the answer lies in this graph. The green bars represent net income, and purple bars are the share repurchases. And we can see that Siri returned much more capital to shareholders through buybacks than it earned in its net income, and the difference mainly came from the debt they issued. And this resulted in the falling share count from almost 7 billion to less than 4 billion recently. So basically, going forward, if Siri is worried about debt level, it can stop or decrease these repurchases and just pay down the debt. And this is exactly what the management announced recently. They said that they will focus on paying the debt until the debt to EBITDA level falls below 3 times. Bulls believe that this debt reduction is achievable because even though Siri is going through a capex investing cycle now, this cycle will peak in 2024 and fall dramatically after 2025. This was announced by the management team and confirmed again in recent conference call. So after this cycle, Siri's maintenance capex can be as low as $100 to $200 million per year for a decade. And so for the long term, stable cash flow level can be between 1.5 to 1.7 billion per year, which can comfortably manage its current debt level, and any potential interest rate reduction from Fed will be an extra help. Finally, bulls think that there is a potential for M&A, and there are largely 3 reasons why they think that. First is tech companies' increased focus on subscription business. Second is increasing adoption of electric vehicles and self-driving cars. And third is current restructuring of the company structure. For example, Amazon is strengthening its Prime subscription business as it invests more and more in its Amazon Prime Video service, and its media retail competitor, Walmart, is working hard to strengthen its subscription merit by working with other streaming services. Similarly, Google is also pushing YouTube Premium as one of its growth pillars, and its recent announcement to close Google Podcast and add it to YouTube Music is one example. So such focus on subscription business makes Siri's 33 million subscriber base very attractive target. Also, the fact that Siri already has long contracts to various live sports is another plus, because as we saw in recent news, the competition to stream live sports is heating up, and Siri can be a supplement to big tech companies' live sports coverage. Next, Siri is a unique position because it's not just another streaming service, because this company has direct access to millions of cars using its satellite network and the hardware devices, which it planted in those cars for more than a decade through partnerships with various OEMs. And regarding this, the fact that Apple decided to drop its Apple Car business is a positive development, because now Apple and Google's Android will have to compete more directly in order to get into the infotainment system of cars, which will be more and more important as cars become electric and as AI penetrates the market through self-driving, which will free up people's time in the self-driving cars. If Apple, Google, or any other tech company buys Siri, it will have a leg up in the infotainment market share competition. Of course, such potential M&A is just guesses for now without any hard evidence. However, the fact that Siri is currently going through a restructuring process just makes us wonder more, because there is actually no clear reason why this restructuring is happening at this moment, while Liberty Media Group has very similar structures with various other businesses that it's not doing anything about. Now that we've looked at the bull and bear theses on Siri, let's move on to investing analysis based on numbers. First, here I ran the scenario where free cash flow drops by 30% due to capex cycle and only recovers to recent level in 2029, much later than what the management is projecting. But even in this case, the long-term shareholders can expect about 15% IRR. And if we assume the stock price remains stagnant for many years, and the company takes advantage of it through buybacks after lowering its debt first, then the long-term IRR can be even higher at about 17% at current price. Second, I looked at the dividends. Siri started dividends in 2016 and continued to increase its dividend by about 10 to 20% per year. And this increase can continue despite the increased capex and debt reduction we've looked at before, because the free cash flow payout ratio is just about 25% currently. Of course, if the operation declines dramatically, all these projection numbers will break. But if we expect just maintaining current level, Sirius dividend can continue to grow from current 3.4% dividend yield to much higher level. Finally, when you analyze SIRI, you should consider its M&A with its parent company, SiriusXM. This M&A deal is a bonus feature, and it's already covered well in other YouTube videos. So I will just add link to the video that you can check out later. And just to summarize it very quickly here, these two companies will merge in the third quarter, and each SiriusXM share will turn into 8.4 SIRI shares. And a good risk arbitrage strategy here will be going long on the cheap stock and going short in the expensive stock. And through this, investors can make a safe arbitrage profit. But here, how can we know which stock is cheap or expensive compared to the other? For example, when Berkshire bought the stock recently, it focused on SiriusXM stocks. And that's because, as you can see in the green color here, considering the exchange ratio, SiriusXM shares were trading at cheaper price. But more recently, when both stocks fell dramatically, SIRI shares actually became the cheapest of the three. And even though this is a simple calculation, it can be confusing, especially if you are not used to such M&A situations. So I made a simple Excel calculator that you can download through the link below. And the way to use it is just put the current market prices of SiriusXM and SIRI, and whatever number that's covered in green is the cheaper of the two. So at the moment of making this video, SiriusXM is actually cheaper. But if that stock price goes up a little bit, SIRI can be a better buy, and I use this simple calculator whenever I trade these stocks. But as always, please keep in mind that this is not an investment advice, and I am just sharing my research result to you guys. As always, thanks for watching our video, and please hit the like button and subscribe to the channel if you want to receive more analysis like this. And it will be interesting to hear your perspective on SiriusXM as a consumer who does or does not use the service. Thanks guys.